Welcome back to the channel, and if it's your first time here, you couldn't have picked a better video to watch. No matter what your income level, currently you can convert an unlimited amount of assets from traditional IRAs to Roth IRAs if you pay the taxes now. Now, there used to be an income cap, but that tax law was changed back in 2010 to allow anyone the opportunity to convert. That huge advantage may be slipping away. As a reminder, if you have traditional IRA assets, you took a tax deduction at some point in the past, and you will owe taxes on those funds at some point in the future. And Congress is counting on it. They're salivating at the chance to grab a large portion of those assets. As we learned in part 4 of this series, a Roth IRA allows for tax-free growth, tax-free distributions, and the tax-free transfer of those assets to your heirs. In part 5, we are talking about conversions. A conversion is where you elect to move your assets from your traditional IRA to your Roth IRA. You pay taxes now at the historically low tax rates and never are taxed again. Stick with me and I'll explain why Roth conversions are so important to the 0% tax bracket in retirement and why the clock is ticking on this tremendous strategy. Hey, Colin Exelby here, and I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and provide advice virtually to clients all over the country. Currently, anyone, no matter their income level, has the opportunity to convert traditional retirement accounts into Roth accounts. That may or may not still be the case in the future. I could easily see a scenario where Congress puts a cap on the ability to convert by higher income individuals. In fact, prior to 2010, the MAGI income threshold was only $100,000 per household. The Build Back Better bill, if passed, has restrictions on conversions for those with higher incomes, but those restrictions don't kick in until 2032. That's interesting, because by putting that date into play, what it actually does is incentivize more smart people to take advantage of Roth conversions, which ultimately raises the taxes that government is able to have over the next few years. This is a good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. So, while we are still in these lower tax brackets and while conversions are unlimited, it may make a lot of sense to convert assets and pay taxes now. Are you in an artificially low income tax bracket because you sold your business? You semi-retired or are in between jobs? Are you under 40, building your career and still in a low income bracket? Are you retired but not yet claiming Social Security? Are you over the age of 59 and a half but younger than 72? Then you, my friend, are in the sweet spot for Roth conversions. You pay some tax now, but then have tax-free growth and distribution in retirement, while building a tax-free legacy for your heirs. In my opinion, there is not a better time than now to explore how a Roth conversion can help your financial situation. Well, actually, there could be a better time. As I release this video, the stock market is trading just off its record highs. But if markets were to fall more significantly, it makes this strategy even better. You know why? You can convert assets while markets are down, pay the tax then, and then get the growth tax-free on the way back up. For those who converted in 2020 during the COVID pandemic, they look like geniuses right about now. From February to March of 2020, the S&P 500 fell roughly 35%. What if, at that time, You had your IRA, you converted the assets while the markets were down, and then as the market has rallied back and even beyond where it was, all of those gains are tax-free all into the future? I mean, if you did do that, kudos to you. But that's the type of strategy I'm talking about, and that could be the optimal time to do it. It's always tough to pay tax now. I get it, trust me. I want to pay as little as possible. But if the trade-off is pay a little bit now to not pay tax in the future, I will write that check all day long. But the real kicker here is that Roth IRA distributions don't count as provisional income, so they can't make your Social Security taxable. I'll say that again. Roth distributions in retirement do not make your Social Security taxable. This video series is all about creating a tax-free income in retirement. It is possible to create a strategy where you either contribute or convert assets to Roth IRAs, pay taxes over the next 5 years while we have these low rates, and reposition those assets for future distribution without tax. That is powerful. Now, most of us will have Social Security income, assuming that it's around, in retirement. The delay and pray strategy employed by many allowed us to build up large pre-tax 401k and IRA balances. If you do nothing, when you retire and take distributions, those distributions will most likely make your Social Security taxable. The key to a 100% tax-free income in retirement is to begin positioning yourself now. By converting assets systematically over time, you can create a Roth IRA balance that can be withdrawn on your terms, not the government's, without taxes and without making Social Security taxable. So how do you pay the tax on a conversion? In most cases, Roth conversion tax will need to be paid from non-retirement assets. You can only do the conversion if you have money to pay the tax. That's generally why it's best to split up conversions over multiple years. And this is also the biggest reason why more people don't do conversions. It's nearsighted. If you don't pay the tax bill now while you're in these low tax brackets, you and your beneficiaries will most likely pay even more tax later on all the future growth and withdrawals as they push you into higher tax brackets. Another point to remember is the 5-year rule. If you are under age 59 and a half and convert assets to a Roth IRA, the assets that are converted must be held for 5 years before any withdrawals can occur. Otherwise, you are subject to a 10% penalty. Now, if you remember from Roth IRAs in the other videos, contributions can be taken out without penalty and without taxes. These on these conversions must be held in that Roth IRA for at least 5 years. So when can you pay the tax from retirement assets? Well, if you're over 59 and a half. You see, at 59 and a half, you can withdraw IRA assets without the 10% early withdrawal penalty. So you could do a conversion and then withdraw more assets to pay the tax. You have to be careful not to push yourself into a higher tax bracket though with the extra withdrawals to pay the tax. That's why, in my opinion, the best way to convert is to pay the tax with non-retirement funds. In my opinion, now is the time to consider converting your IRA assets. But conversions aren't for everyone. When doesn't it make sense? Here's a quick rundown of when a Roth conversion does not make sense. First, anyone that can't pay the tax on the conversion, because once you convert, you commit to pay the tax now. The second reason, anyone who believes that their future tax rates will be lower than their current tax rates. The third reason not to convert is if you have a low tolerance for volatility and want the assets to be in safe, low-yielding investments. Generally, it doesn't make sense to convert assets, pay the tax, and then not invest them in growth-oriented assets. The fourth reason is something that I like to call stealth taxes. These are taxes because a conversion increases your adjusted gross income, and you could raise your income to a level where you don't qualify for certain things, like medical deductions, or the IRMA surcharge on Medicare premiums kicks in, or you lose child tax credits and education credits, or the taxation of Social Security, or even the loss of the 20% QBI deduction for business owners. These are all what I call stealth taxes, and you want to be aware of them. But if these are triggered, it's often a one-time short-term expense to gain a much bigger benefit in retirement. The next reason you may not want to do a conversion, if you are applying for financial aid. The increased income from a conversion could impact it. IRA assets are generally excluded from financial aid assets, but the income from a conversion is not. So you may want to wait until financial aid isn't needed. Another reason you wouldn't want to convert is if you need the funds soon. If you pay tax now and don't allow the funds time to grow, then this strategy will backfire. Conversions are not for the short term. And the last reason that you may not want to convert is that generally if you are over 72 and subject to RMDs, your conversion window may be over. The only funds eligible for conversion would be those above the RMD. RMDs cannot be converted. And remember, RMDs are required minimum distributions. Notice that as I said this, I said generally, because in certain situations, conversions above the RMD can make sense. Ideally, if you have a younger spouse or beneficiaries that you plan to leave the assets to, then converting now, paying the tax, and allowing that tax-free growth for them may make a lot of sense. Every situation is different, so work with your tax and financial advisors to create your Roth plan before it's too late. And if you're loving all of these tax-saving investment strategies, make sure to watch this video next, Unlocking the Power of the Health Savings Account, triple tax-free.